Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. And we are back with our Sunday guest, Mr. Dan Bird, who catches us up on what's going on in the market, tackles very interesting topics in his weekly newsletter, which I read sometimes entirely, sometimes I skim, but always laugh because the cartoons are a big part of it, man. Thank you very much for being with us almost every week. Thanks, Dan.
You bet. I was just mentioning to you, I'm just recovering from COVID. So if my voice sounds a little hoarse, that's the reason.
There you go.
I'm actually feeling a lot better today. Today's day 6.
Yeah, I wouldn't have known except your voice, because I've known you for quite a while. It's a little raspy, a little deeper actually than normal.
Yeah, that's right. Yesterday was even deeper. I could have been a DJ.
There you go. There you go. Well, hey, why don't you flash your newsletter? Tell people where they can get it. First and foremost, your mind is where I'm at, right? Let's talk about yield curve inversion. We are there again. I think it's day 3 of this inversion. What is it? Why is it? All this great stuff that you put out in the chart was just in the article is amazing.
Okay, here's some snippets from this week's newsletter. If anybody wants to get it, just send me a note, an email to breakpointtrading@gmail.com, and I'll add you to the list. And it's just something I do on my own. There's no charge for it.
Yeah.
So if you disagree, that's fine, no problem. You can even send me an email and say you disagree.
Yeah.
And we can have a discussion. A few of your listeners have done that. We've had back and forth conversations about,
Awesome.
What some of this stuff means.
Yeah. One thing you will see in these weekly things, it's data intensive. If you like charts, if you like data, definitely gives you enough to inform your own opinion. He's not a stock analyst or anything of that nature. He's doing this for himself. And he does put in some humor, as you can see. I like the one in the upper right corner. Your yield curve line is inverted. I'm afraid I see an economic contraction in your future. I thought that was
Yeah,
funny.
we're going to talk about that.
Yep.
We'll talk about this yield curve down here too.
Okay, very cool. And if you want to get a copy of this, you're watching or listening, I should say, on the podcast, it is breakpointtrading@gmail.com. All right, Dan, tell us what we got.
All right, well, let's start with the yield curve. Let's see, here we go. Let me see if I can make this a little bigger. How's that?
Perfect, thank you.
All right, so this is basically, this is the way most people look at the yield curve. It's the 10-year yield minus the 2-year yield. And that when you do that calculation, if it comes in below 0, then it's inverted. All
and
right,
why is that? You'll get into this, but really, why is that important? I mean, can you ever think about loaning money out for 10 years and charging less than 2 years? I mean, it's logically doesn't make sense.
well, it does make sense when depends on the reasons behind it. But as the Fed increases rates, and those rates typically are on the short end, right? So the short-term rate, the 2-year and other short-term rates start coming down, even though the long-term ones may not right away. So it's an implication or a symptom, let's say.
Oh, okay.
That the rates in the marketplace are changing, and they're leaning more towards short-term versus long-term.
Okay.
Now, and that normally leads to a recession.
Mm-hmm.
I mean, it's the jury's still out of whether it creates a recession or whether it is an indication of a recession.
Interesting.
And it might be a combination of both. I mean, the reason the yield curve comes down like that is because rates are changing. Rates are changing because the economy is changing, right? Which then eventually leads to contraction in the economy. The interesting thing about this is that it usually happens 6 to 9 months before the actual recession. And you can see that right here. So this is the COVID recession. COVID way back here, and I just got it for the first time.
Wow.
Because I went to Mexico. So somewhere along the way, I was on lots of flights, and I have no idea where I got it. My wife didn't get it, just me. So, but it was just like a bad cold, basically. I mean, COVID is a coronavirus, and the common cold is a coronavirus. They're the same thing, So the common cold that we've had for years and years and years is a coronavirus. So there's no difference really. It's just that this one had never been seen before.
Okay.
So that's what it felt like, just a common cold. So if you hear me coughing once in a while, that's the reason.
Okay.
At any rate, this gives you some historical context, and that's what I like about charts and the data.
Yeah.
Is that it gives you a visual and a historical representation of what's going on.
Yeah.
So we can see back here in 2008.
Yeah, sorry to interrupt. You have
Okay.
something on this screen that I want to hit again. So we've already talked about the 10 and 2, and that is what most people call. I just noticed your chart. You have the 10 and the 3 month.
Yeah,
Tell me about that one and why
that's
that
really
one's
important. So banks and most individuals aren't usually borrowing, unless they're buying a house, of course. They're not borrowing on 30-year timeframes.
Okay.
They're borrowing on much shorter timeframes.
Okay.
So while the 10 and the 2 is the one that all the analysts on CNBC that you hear about, that probably this week you've heard over and over again, the yield curve's inverted.
Yep.
Everybody's been saying it. They're referring to the 10 and the 2. But actually the more important one, I think, as far as determining where the economy is actually going, is the 10 and the 3 month. So I included that here also in historical context, and you can see that when the 10 and the 2 inverted before the last 2 recessions, the 10 and the 3 month also inverted.
Now, I don't know if you've looked back, but I'm going to ask, have you gone back farther?
I have not gone back any further than this.
That's okay.
I could.
Oh, wow. Look at you.
Let's see. Can I? Let me try it and see what happens. No, I did a predefined range, but this only goes back 5 years, I think. Nah, I can't do it.
That's okay. The reason I ask is because the 10 and 2 is written about in economic books, right? It's one of those rules of thumb. Very few people talk about the 10 and 3 month. I've certainly heard the discussion. I've certainly looked into it. I think you're right. I think it's far more important because, again, the average consumer who I study, far more likely to have short-term money.
Right.
And I think the 10 and 2 is more of a business, right? There's businesses raising capital and things of that nature, inventory, things of that nature is more important. But yeah, consumers, the 10 and 3. And it's very odd that it happened in its, what is it, 1% today, the delta on the positive? So it's not.
A little bit more, but yeah, about 1%.
Okay.
1.1 is the 10 and 3 month.
Oh, I see it now. 1.1.
And negative 0.03.
I see it now. Okay. That is interesting. That'll be one to watch. Okay. Thank you. I was just
the reason I include that, and it's always been included on this chart. Number one, I think it's important, but number two, I just think it's interesting to see. I always look for divergences.
Yeah.
Right. Divergences tell you what's happening underneath the market. And you can also see that the 10 and the 3 month is coming down really rapidly as well.
Yeah.
So it could very easily, especially if there's another rate increase, it could very easily invert in the very near future. But the important thing to look at is historically, before the recession, it has inverted along with the 10 and 2.
Yep.
Now back before 2008, the 10 and 2 inverted first, and then the 3 month inverted a little bit later.
Okay.
In 2020, the 3 month actually inverted first.
Yeah, I gotta tell you, that one feels kind of like once in a lifetime.
Oh yeah, it absolutely was a once in a lifetime. It's a once in a generational.
Yeah. I would think it would again, normally I think these are great, but normally speaking, I'm just gonna wild ass guess the 10 and 2 inverts first, and then normally speaking, the 10 and 3 might invert next.
Right. I think that's probably true.
Okay. All right, cool.
The other thing to notice on this is that the 10 and 2 inverted back here in 2006, a full 2 years before the recession.
Yeah, and it stayed inverted for a long time.
Yeah, so while CNBC loves to get viewers and keep you there so you can see their commercials, they're going to talk, ad nauseum about the 10 and 2 inversion. Oh, there's an inversion. That means that a recession is coming. Well, it might mean a recession is coming, but it doesn't mean it's going to be tomorrow. And I actually had a comment. Somebody sent me a note saying, it looks like the next report, GDP report, might be negative. That means we've got 2 in a row, negative GDPs. That means the recession has started. I said, no, it doesn't mean it started. It means that we're already in one for 6 months. It means we've been in one for 6 months. It doesn't start as soon as you get that second quarter GDP report. That's not when it starts.
Yeah, that's actually, let's have that debate. So again, as you know, I studied economics in college, got a degree in it. There's obviously, you've already referenced in a rule of thumb that has worked every year, every time back to 1947, where if we had back-to-back quarters of GDP, it was called a recession. That's a rule of thumb.
Right.
The economists who ultimately will look in the rearview mirror and say yes or no, there's 4 variables they look at. One is retail sales.
That's right.
One is industrial.
We're going to talk about that in a second, too.
Oh, we are. Okay. Well, I'll just leave.
I forgot to put in my newsletter, but I'll put it in next week. But
I won't read ahead. I apologize.
No, go ahead. You're on the right track. There's 4 things that they look at.
Yeah. So again, retail sales, industrial productions, real incomes, and most importantly, jobs.
Right.
We had 6 months of jobs creation. The lowest job count was 372,000. There were 2.4 million jobs created in 6 months. There is no chance in hell these first 2 months will be called, or first 2 quarters will be called a recession, in my opinion, even if they're both negative, which we don't know for sure.
Yeah. So we'll come back to this unemployment rate down here at the bottom of this chart.
Okay.
I included that as well, because all of these things are important to look at the same time. But this is not something I was prepared for, but since you brought it up, I want to touch on the definition of a recession.
Okay.
Because everybody uses 2 consecutive quarters of negative GDP growth.
Well, again, it's worked for, I don't know, 70 some years. It's just not the official definition. But
well, it's easy too.
Exactly. It's easy. So, every armchair economist can use it.
Right here, it had been typically recognized as 2 consecutive quarters of economic decline as reflected by GDP. All right. Officially, 2 consecutive quarters of decline in real GDP is not how it is defined anymore. The NBER defines a recession as a significant decline in economic activity spread across the economy lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. Exactly what you just said.
Everything I got a degree in this. I can't believe
it. That's actually how the Fed and economists will look at the recession.
Yeah.
But everyone on CNBC will raise the red flag if we get a negative GDP on July 28th.
Yeah.
And say we are in a recession, but that's not exactly how a recession is defined.
It is no, and believe me, I live in a YouTube universe where I'm trying to educate and talk about finances as you're part of my Sunday Expert series. There is going to be endless amounts of people screaming we're in a recession if Q2 is negative, and it's
well, they're already doing that. And interestingly, I mean, like this one person said, if they say we've got negative GDP in Q2, then the recession will begin.
No, it's okay.
No, the recession won't begin. The recession might be 2 months in already.
Exactly. So yeah, it's
or it might not be a recession at all. Now, they don't really actually call a recession. The NBER, who is the National Bureau of Economic Research, they're the ones that officially call it a recession.
Yeah, simply said, there are 10 PhD economists that sit around a table, look at the data, and call it. They always call it in the rearview mirror.
And 6 months later.
Yeah, 3 to 6 months. Yes.
Right. So, I mean, we're not going to know if it's a recession until we're well on the way to a stock market rally.
But let's just talk about it, because again, I've looked at this. There's really 4 factors again. Retail sales have been up and down for the last 6 months. Not
okay. Let's since you bring that up again, let me go to the chart that I forgot to put in.
Okay, go for
it. This week, but I'll put it in next week. Here is real spending.
There you go.
On clothing and footwear, and durable goods. The one at the top is durable goods,
Mhm.
excluding new and used motor vehicles.
What is the trend? What's the red?
The red is the pre-COVID trend,
Oh, got it. Got it. So we are
right?
above.
So again, CNBC in the last week or so has had all these analysts coming on saying consumer spending is down, consumer spending is going down, the world is ending, consumers aren't spending as much anymore, it's over.
Yeah.
Well, yeah, that's true. If you look at the chart short term,
Yeah.
the trend is down, but it's well above the pre-COVID trend.
No, I agree. This is why no matter what the negative, even if there's a negative, it will not, I've already said it on my channel, it will not be called a recession in hindsight, my opinion.
Right.
Yeah.
Now, I agree with that. And I've said all along that even if we get a recession, it's going to be a shallow and short one.
Mm-hmm. Okay.
Because we are in a secular bull market, right? Can I hear from the chorus?
Yes, secular bull market. Got it.
Market.
Got it. But we could still see, again, we'll get into the charts. I'm looking to go shopping at 3,100, as you know.
Okay. I thought it was 35.
No.
Keep
30,
lowering.
32 to 31, 31 to 3,200.
All right. Well, we'll look at that too, and we'll see if that's in the cards. All right. So the unemployment rate down here, we just had that number on Friday.
3.6.
Yep, 3.6, stayed at 3.6, 4 months in a row. You can see it's kind of flat line down here.
Yeah. Interesting,
again, historically, if we look back before the 2020 recession, it was flatlined, well below 4. This pink line is 4. And before 2008, it had reached the low and was kind of flatlining down here, a little above 4.
I don't know if you know this. I've said it on my channel. So when I was getting my degree and we had to study employment, we always assumed full employment was 6%.
Yeah.
It was corrected or changed about 2004, 2005 to be full employment at 5%.
Right.
So now we've been at 3%, sub 4 forever. This is not normal. Yeah.
Well, it's everything from this big drop right here, this gray area, that's the COVID recession. Everything from here forward is not normal.
Oh, no, agreed. But totally agree. Totally agree.
The supply chain is not normal. The supply and demand is not normal.
Totally agree. Interest rates weren't normal.
Everything is out of whack. Everything is trying to come back to the mean, actually.
Totally get it. Yeah, totally agree.
That's where we're at. But the point that I wanted to make here is that the unemployment rate is a lagging indicator. In fact, it is a very lagging indicator.
Totally.
It is probably the last indicator.
Yes.
Before a recession actually happens. So
I would agree.
You can't look at the unemployment rate and say, okay, 3.6, no recession. That's probably true for now, because historically, if you look at this, the last two, and this is true of all of them, by the way, unemployment rate is the lowest just before the recession. The lowest.
I've seen that.
So it's when the unemployment rate starts to rise off the bottom that the recession occurs.
Correct. We agree.
So the number on Friday was a better than expected number.
Yeah, expected 250. We got 372.
Interestingly, and I think this might lead to my next chart. Let's see. Yeah, well, we'll look at the VIX here. Interestingly, I was hoping for a worse than expected, but not a bad number.
Yeah.
Because I thought the market would love that and actually take off. Well, the market actually went up on a higher than expected number.
Yeah,
I thought it would be the opposite. I thought the market would sell off.
Yeah, I thought I thought we were in the good news is bad news is good news scenario. But
right.
Yeah.
Maybe any news is good news.
Yeah, I guess just news is news.
But this is my go-to VIX chart. Anytime the gray line is the VIX, the red is the 5-day moving average of the VIX, and the green is the 21-day moving average of the VIX.
Okay. Just
to visually see, whether it's accelerating or decelerating. Whenever the gray crosses over the red, then that's typically marks a change.
Okay.
So the gray here came down, it touched it, went back up and crossed over right here. And if you follow that down, that's where the bottom was.
Okay.
That's the bottom that Tom Bowley called
Mhm.
a couple of weeks ago, by the way.
Yes.
All right, so there's the VIX. It's when it comes back up, like right here, when the gray comes back above the red, that's the red lines. That's when we're usually at the top.
Hmm.
Okay.
Mhm.
So this one's at the bottom, this one's at the top, or close to the top, etc. What happened on Friday, I was really expecting the market to not like that number.
Yeah.
And for it to sell off and for
Me too.
volatility to spike. It didn't. Volatility actually dropped and the market went up.
Hmm.
So we had buyers and low volatility.
Hmm.
So the market is telling us. Now, I don't trust this yet because we've got the CPI number coming on Wednesday.
Yeah, we'll talk about that in video too.
Yeah, but I just think it's really interesting. I mean, all of these numbers here, including this down here, which is the percentage of stocks above their 50-day moving average, which at the bottom that was called right here was the lowest it's been. It's only been that low 3 times in the last 5 years. And it's only been that low 6 times in the last 21 years.
Interesting.
6 times.
Hmm.
All right,
Okay,
now it's coming back up. So now we're almost at 30% of the
Hmm.
stocks in the S&P 500. What is
Got it.
that?
150.
Yeah, 150 stocks
Yeah.
in the S&P 500 are above their 50-day moving average. So
Uh,
that's good. That's healthy.
Yeah. I like it.
I mean, everything I'm seeing is pointing to, here's another view of the yield curve, but everything I'm seeing is pointing to the market really wants to go higher. So this is my sustainability graph that we've talked about many times. It's one that I look at a lot lately.
Yeah.
Because for those who haven't seen this on your channel before, and we've talked about this many times.
Yep.
This is the S&P up here. As it was going up in December, making new highs, the consumer discretionary compared to the consumer staples was going down.
Mm-hmm.
The NASDAQ versus the S&P was going down, and growth versus value was going down, even as the market was making new highs. What that means is big institutions were rotating out of growth stocks that they'd been in for a couple of years because they were preparing for a market decline.
Mm-hmm.
So they were rotating out of the growth stocks, and they continued to do that as the market continued going down here.
Mm-hmm.
They continued rotating out of growth.
Yeah.
So all of these areas down here is growth versus value,
Got it.
or aggressive versus defensive. And if you see this trending down, that means big institutions are rotating into defensive areas, defensive sectors, until the end of May. Actually, first part of June. Actually, right after the last CPI number. So we talked about that before. Here's where the last CPI came in. Actually, it came in the day before the market started crashing already. Somebody knew what the number was going to be. And then it gapped down 2 days in a row and went all the way down to here. This was the low. Mm-hmm. All right. So as it was making this big low right here, look at what's happening to growth and aggressive. They were trending up. Institutions were rotating back into growth and technology stocks.
Yeah.
And you saw that in a big way last week.
Yeah, we saw that a lot. I mean, Kathy Woodstock's got to be up a bunch.
We'll look at that in a minute.
Okay.
But so I mean, I have been saying this on your channel for 3 or 4 weeks.
Yep.
Last week it was really apparent. Where all the and CNBC was saying it too. CNBC was saying, "Oh, growth is back. Growth is back." Well, I've been saying growth is back for 3 weeks now.
And he has a playlist you can go back and watch.
Right. And it's because of this, and that's why I look at this all the time. Now, if this, like, I took the green arrow off of the discretionary versus staples because it stopped making a higher low.
Oh, okay.
Like the other ones did. You know, it's higher low, higher low, higher low, higher low.
Got it.
But this one came down and it touched its previous low.
Got it.
So it wasn't making a higher low here. So I took the green arrow off of it, but it didn't go below its previous low.
Okay.
And then it started coming back up. So we are still in a mode where the market wants to go higher. However, there is a lot of work to get through right here. So this is the key right in here, getting through this downtrend line, which is at right about 39.50. And we ended Friday at 38.99, call it 3,900.
Yeah.
Right. So 39.50 is this downtrend line. And the 50-day moving average is at 39.84.
Yeah.
So let's call it 4,000.
Okay.
We need to get through 4,000
Mm-hmm.
to get all of this crap behind us. All the times where we've gone up and hit these downtrend lines before and got rejected and continued down, making new lows over here.
Mm. Okay.
And I'll show you when we talk in the next segment. I'll show you.
Yeah. Let's
what
just
gets
flash Kathy Woodstock, and then we'll get.
Yeah.
on to
Let me
video.
just talk about this.
Sure.
We started off with the yield curve.
Mhm.
Let me talk about it again real quick.
Sure.
So again, on CNBC, everybody's saying, the yield curve's inverted, yield curve's inverted. What they mean is the 2 is lower than the 10 is lower than the 2.
Yep.
Right. So this is the yield curve graph from Stock Charts, and you can get this for free. You don't have to sign, you don't have to, subscribe to it. You can just log into Stock Charts and you can see this yield curve graph. It's actually dynamic. So you can actually run it. I did this once before on your channel, but you can run it. It goes all the way back to 1980 or something.
Mm-hmm.
Shows you what the yield curve looked like over the years.
Mm-hmm.
This is what it looks like right now. They're saying it's flat. They're not saying inverted. And the reason for that is that CNBC will say it's inverted because the 10 is lower than the 2. But it's only in this area right here between the 2-year and the 10-year that the inversion is occurring. From the 3-month to the 2-year, which I showed you before,
Mhm.
it is not inverted.
Mm-mm.
And from the 10-year to the 30-year, it is not inverted.
Right.
So a real yield curve inversion means that all of these have to be inverted, not just the 10 and the 2. Now, the 10 and the 2 might be an indication that we're headed that direction.
Right.
But technically or officially, it is not actually inverted.
Interesting. Very cool. Very cool. Well, Dan, once again, thank you for doing your weekly newsletter. I am a receiver of it. Remind people what it is if they want to get a copy of it each week.
By the way, I covered these topics in the newsletter as well.
Mm-hmm.
Oops. Right here. Breakpointtrading@gmail.com. If you'd like to sign up.
Yep. Very cool. We will.
And the next segment, we'll talk about the CPI number coming next week, which is critically important. And I'll go over some more content that will indicate whether or not we are going to break out. Next week is critically important.
I couldn't agree more. I look forward to it. Thanks, buddy.
All right. Take care.